What's really driving mortgage rates over the next 12 months? It's an important question, and you need to know the answer. There are two primary things that are impacting mortgage rates in our marketplace today. Number one is inflation. Yes, we made significant work against inflation, but the Fed thinks there's still more work to do. They need to get that number down to a targeted 2%, which, by the way, there's no scientific number behind 2%. That is just a number that the Fed over the recent decades has believed is a healthy cost of living increase, which is essentially what inflation is. So the Fed wants to see that number pushed down and maintain at a 2% inflation number. That is the number one thing impacting rates. And when we see data that pushes inflation up or shows inflation trending down, that is going to cause movement in the markets, which are going to impact our mortgage rates. What's number two? Well, the second thing that impacts rates right now is employment. The employment situation has been fantastic. In fact, for some time now, with the exception of the blip of COVID, which was a huge blip, our employment has been very strong. If you want to see the last time it really took a hit, go back to 2008. In fact, that's really what caused the crash of 2008 was employment issues and the economy not sustaining the level of employment that we had. So the Fed has attempted to bring inflation down, but they also don't want to negatively impact employment. That's actually not 100% accurate statement. They're okay seeing employment slow down, but if they overcorrect and they bring things back too far, then unemployment numbers would actually skyrocket and that would impact the economy. So they're trying to make sure they're bringing inflation down. They're okay with a little increase in unemployment, but they really are monitoring that. They want to see a healthy balance on both sides. So the two biggest things that are impacting mortgage rates in the next 12 months are inflation and employment.